In today's video, I'm going to teach you how to use margin on Oanda. Let's start with the simplest possible definition. Margin is the portion of your account balance that's set aside to open and hold a trade. Think of it as a security deposit. By using margin, you can control a larger position than the cash you have in your account, thanks to leverage. For example, if you have a balance of $100, leverage can allow you to control a position size of $1,000 or more. Just remember, leverage cuts both ways. It can amplify potential profits, but it also magnifies losses, so careful position sizing is essential. Using margin on Oanda is straightforward because the platform handles the mechanics for you. Open the trading platform you use with Oanda, whether that's FX Trade, MT4, or MT5. Choose the instrument you want to trade. This could be a currency pair like EUR-USD, a commodity like XAU-USD, or a crypto pair like BTC-USD, depending on what's available on your account. Decide whether you want to buy or sell based on your analysis. Enter your trade size in units or lots, then place the trade. That's all you need to do. The platform automatically allocates the required margin. There's no separate switch or special order type to enable it. Here's what happens behind the scenes once you've placed the order. Oanda reserves a portion of your account balance as margin. This amount is called margin used. What's left over and still free to open new trades or absorb market moves is called margin available. You'll typically see both values in your account or trade summary, updating in real time as prices move. There's a simple way to understand the calculation that powers this. Margin used equals trade size multiplied by the margin requirement. The margin requirement is set by the broker and varies by instrument. It's often shown as a percentage. For instance, if your trade size is $1,000 and the margin requirement is 5%, the margin used would be $50. As the notional size of your position increases, so does the margin that's set aside. A couple of practical tips as you apply this. Keep an eye on your margin available, especially during volatile markets, because price swings can quickly increase your used margin relative to your balance. Consider choosing a trade size that leaves a comfortable buffer so normal fluctuations don't stress your account. And always remember that while margin helps you access larger opportunities, it also requires disciplined risk management to protect your capital.